Now NBC News senior White House correspondent Kelly O'Donnell, CNBC senior markets correspondent Dominic Chu, Heather Boushey, former member of the Council of Economic Advisors in the Biden administration, and former Republican Congressman Charlie Dent from Pennsylvania. So, Dom, what is this survey about, and what's your takeaway from it?
So the University of Michigan survey, as you just point out, Jose, it did reflect, as you point out, a pretty dramatic drop in consumer sentiment. So that University of Michigan consumer sentiment read of 50.8 is a drop from a prior level in the previous month of 57. It was also below economists' forecast for a read of 54.6. A lot of that has to do with how scared consumers are, as you point out, of inflation becoming a much bigger force in the American economy over the next year. The expectations on that front really jumped. Survey respondents now think that inflation a year from now will be closer to 6.7%, which is notably higher than the prior read of a 5% rise in inflation. It is, by the way, also the highest expectation since November of 1981, when the country was still reeling from the effects of sky-high inflation back then. This sentiment data, as you point out, comes across all of those different demographics. So what it does tell you is that there is a renewed worry, Jose, about inflation in the American economy.
Heather, what do you make of it and this University of Michigan survey, poll, etc.? How much weight does it have?
Well, this is what they call soft data. It's a survey of how people feel about the economy. And let's be clear that because of the strong economy that this president inherited, the hard data has continued to come in fairly good. We got new data on inflation this week that shows that it slowed, and we are not seeing that being a problem in the backward-looking data. But to this report from the Michigan survey on how people are feeling about the economy really is indicative of a lot of Americans who are scared that prices are going to go up. And of course, we're already starting to see firms announcing job losses or layoffs or not hiring because of the chaotic way that the president is implementing economic policy. So I think we need to take this very seriously. We need to, and I'm certainly that the Fed will take this very seriously in terms of understanding just how worried people are about the direction of the economy and what it will mean for them, both as workers and as consumers.
And, the president has talked about essentially rearranging the world economic order and has been touting companies announcing hundreds of billions of dollars of future investments into the United States. Those would presumably create maybe thousands or tens of thousands of jobs in the future. But let's talk specifics about today, Heather. What do you think the impact is of these Chinese 125% levies announced overnight?
Well, what we're doing, what we're seeing this administration doing with this chaotic tariff policy, on again, off again, up, down, maybe. Now certainly the president is focused on the trade war that he has started with China. And what that means is that prices are going to rise in the short term. The president is arguing, well, there'll be some pain, but companies are going to invest. But what the administration is not doing is creating the conditions or the wherewithal or the security and the certainty for firms to make those investment decisions within the United States. So on the one hand, he's making things that we import more expensive, but on the other hand, he's taking all of these actions that are not improving investment conditions here in the United States. DOGE has been doing these chaotic, chainsaw cuts all across the federal government, de-investing in R&D, making it harder to enforce labor laws, so we don't think that, maybe these won't generate good jobs down the line. A whole bunch of things are happening behind the scenes because we're also focused on the chaotic tariffs. And yet, even though firms have said, hey, we're going to invest, we need to wait until we see that data show up in the cold, hard data. And what we know of the first Trump administration is even though he did those big tax cuts for rich people and for corporations, and even though he did tariffs, we did not actually see that show up in a ramp up of investment that would be commensurate with his policy shifts. So I think that, I'll wait until we actually see that showing up in the hard data. I think all signs are today today that this is a chaotic time for investors, a chaotic time for businesses, and that is why you're already seeing firms announcing layoffs and announcing that they are stalling investments here in the United States.
What firms would those be that are going to be stalling investment in the U.S.?
Well, you already heard that Stellantis was laying off 900 workers, for example. Cleveland Cliffs has announced layoffs of, I believe, over 1,000 in Michigan and Minnesota. You've already heard that CEOs are announcing that they've got layoffs. I think it was 37% are considering that there may be layoffs coming down the pipeline. So we're starting to see these bubble up. But this has been a very tumultuous week, a week and a half to say the least, in terms of economic policy. And the trade war with China just adds more uncertainty, even as we know that there were some structural challenges in the trade relationship between the United States and China that need to be dealt with in a sane and sensible way so that we can continue to see the kind of equitable economic growth that we want to see here in the domestic economy.
Kelly, what is the White House saying about all this?
Well, as you might expect, the president, who believes very strongly in his policies and likes to maintain flexibility, and we've seen a lot of that so-called flexibility in the way that he has responded to this with the pause, and certainly with China responding, the president has, through his trade representative, has described that as unfortunate. He has also said that all of the countries want to come negotiate. We don't have any indication yet that China is eager to do that. We've in fact seen China respond with their own retaliatory tariffs. So that remains a complex and difficult relationship, and one that is very consequential for a lot of the everyday goods that Americans like to buy in our very strong consumer culture, and of course for all of the importers and small businesses that rely on that supply chain. The president himself, who likes to promote his policies and brings his salesman and branding and pitchman style to his office, today used his social media post to say that it's all going very well. He talked about this, saying, "We're doing really well on our tariff policy, very exciting for America and the world. It is moving along quickly," with the initials DJT. So a placeholder perhaps today from the president, who is separately going to Walter Reed National Military Medical Center for his annual physical, the first since he's returned into office. So there's a period of time today where we won't be seeing the president on camera. Then he heads to Florida. But he can use his social media posts, and certainly top advisors can be out talking today. And we saw that with the trade representative, who described the response from China as unfortunate. Jose?
Charlie, what do you think the political cost is to the president? And I'm just wondering, how do you think folks at the Rust Belt, used to be called the Steel Belt, feel and think when they think about tariffs and about the status quo and about the thousands of jobs that were lost over the decades, even before the 80s, but that have been lost in the Steel Belt, in the Rust Belt, and in so many other places in our country?
Well, my father was in the steel industry for 30 years. I lived and died that with the Bethlehem Steel collapse. But I can tell you right now that a lot of people in this part of the country are a lot more sophisticated in their understanding of the economy. We're done crying over steel, frankly. But I will tell you, people here, I think, are witnessing what many would consider to be a crisis of confidence and competence of the United States government. I think a lot of people are seeing that the United States is isolating itself. It is not doing itself any favors. Here we are declaring a trade war in virtually every country in the world, where there are legitimate, real issues with China, but we've isolated ourselves. And this is a problem. And so people, you get back to the Steel Belt regions that people call, I hate to use the term Rust Belt, but people here have figured out that we are in a dynamic economy. Their heads aren't buried in the 1950s or the 1970s, thinking that we are going to go back to those days. These economies have evolved, and people have largely adjusted. But right now, they're worried about their 401ks. They're worried about price increases. And that is really what's driving the debate now. I think it's imperative that the Trump administration reverse this policy, because this is not going to end well.
Dominic, what are business leaders generally saying about the future and how what's going on today may be an indicator of some problems in the future?
Sure, Jose. I don't believe that the vast majority of the CEOs, CFOs, and senior business leaders that we talk to, I don't think their story has changed at all over the course of the last several weeks, and certainly not in the last couple of them. It hasn't changed from the most senior level for the big reason that, for the most part, the theme that they've been talking about has been that tariffs are generally not good for the American economy. We got a refresh in terms of that economic commentary in the last day or so just. Today, BlackRock CEO Larry Fink was on CNBC just earlier this morning, and he basically said that he thinks we're very close, if not already in a recession right now. He's also the head of the world's biggest asset manager, so he kind of has a different view of how things are moving along. He made similar comments to the Economic Club of New York this week when he said that other CEOs also think the U.S. is, quote, probably in a recession. JP Morgan Chase reported its latest results this morning. As part of that release, the CEO of America's most valuable bank, Jamie Dimon, said that the economy is facing considerable turbulence, including the negative of trade wars, ongoing sticky inflation, high fiscal deficits, amongst other things. He also did, though, mention the potential positives of things like tax reform and deregulation. I would also point out one more anecdote here. Fellow big bank CEO Charlie Scharf over at Wells Fargo said that a timely resolution to the trade wars would benefit U.S. consumers, U.S. businesses, and the U.S. markets. So, Jose, you can also expect to hear a lot more CEO commentary throughout the course of the next several weeks, because just about all of them will be making public comments during their quarterly earnings releases, and a lot of them, Jose, will be addressing tariffs and trade wars.